Hi, welcome back to Joe Blogs. In today's episode, I want to talk to you about what's happening in the economy in the United Kingdom because UK borrowing costs, the yield on gilts, has hit a 27-year high. They're now at the highest level since 1998. So when you think about what's happened in the last 27 years, the current situation in the UK in terms of borrowing costs for the government is the worst that it's been at any time. So that wipes through the global financial crisis and lots of other major financial problems. So this really highlights that there are some serious problems going on right now in the UK. Now, before we get started on this video, I get a lot of people sending me comments saying, why don't you make more videos on the UK? And I would make more videos, but whenever I do make one, it doesn't do very well. Not many people watch it. And the reason for that is because people switch off. So if you want me to make more videos on the UK, there are three things that you can do right now. Firstly, like this video because that helps with the algorithm. Secondly, write a comment. So something as simple as make more videos on the UK, please. And thirdly, subscribe to the channel if you haven't done so already. And in fact, if you haven't subscribed, why not? Because I know more than half the people watching these videos are not subscribers. So smash that subscriber button, put a like on and write a comment, and that will help this video do better and therefore will encourage me to make more on the UK. Well, I might be making more anyway because it looks like the situation is going to hit critical at some point soon. You can see from this graph that the current bond yield on the 30-year gilts of 5.7% is the worst since 1998. And you can see just how rapidly the bond yields have been rising over the past few years. Now, obviously, we came out of the COVID-19 pandemic, so bond yields have risen for all countries because they were at historic lows during the pandemic. But the rate of increase in the UK is really quite concerning. If you look at this chart, which shows the movement over the last 10 years, you can see that between 2022 and the current situation, we've seen an increase of almost 5% in those borrowing costs. And that's obviously really bad news. And it's not just the 30-year gilts that are being affected. This chart shows the movement over the past 12 months of the 10-year gilt rate. And you can see that that's now up to 4.8%, which is the highest that it's been since January of this year. And it looks likely that we're going to break through that level, and then we'll be talking about the highest for decades. So this is a really serious problem. And in terms of answering the question as to why is the deficit getting larger? Why is the UK running up a deficit? Well, in simple terms, if you put it into your own budget, the UK is spending more than it's earning. So it's just like you spending happily every single month and then coming towards the end of the month and thinking, oh, I don't have enough money left. I'm going to have to go into overdraft. And that's exactly what the UK government is doing. It's spending more than it's receiving in taxes, and therefore it's having to borrow money through issuing more bonds. That's how countries actually borrow money. So you can see here that in the first 4 months of this financial year, which starts on the 6th of April in the UK has borrowed £60 billion. And the deficit for the full year is now projected to be 137 billion. So that's basically the UK's overdraft, if you like to put it into simple terms. And that's around 4.8% of GDP. Now, the reason why the UK is continuing to spend more than it's earning is because, firstly, spending is increasing, which is being driven partly by inflation, which is still above the target rate, partly by higher public sector pay, so all of the people who are employed directly by the state, and higher welfare costs. Now, I'll go on to talk about it in a moment in terms of the policy reversals, but when this government took over, it made a number of pledges and then had to reverse some of those pledges because they were very unpopular with the people of the UK. The second reason why the shortfall is increasing is because debt interest costs are increasing because of the rising yield on the government debt. It's costing them more every single time they issue a new bond, having to issue them at these higher rates. And that's going up also because inflation is going up. The money that the UK government is receiving from taxes is not enough to cover the increase in the spending. Revenues are increasing, but not at the same rate as spending is. So they're constantly overspending. Now, the policy reversals that I just mentioned were an embarrassment for the current government. They said that they were going to remove certain welfare benefits, and then there was a huge uproar about it in the press, and so they decided to change their mind. But the problem with doing that is that you then get less money in because you're having to keep paying all of these welfare costs. And in terms of the long-term pressures on the UK economy, well, the triple lock pension deal is something that I just wanted to touch upon, because in the UK, there is a state pension. So everybody pays national insurance to the government when they're working. So that comes from both individuals and companies. And that national insurance payment goes to fund your pension. So when you retire at the age of 67, then you get paid something by the state. And to make people happy, in the past, somebody introduced what's called the triple lock guarantee. And what that says is that state pensions in the UK will rise by the highest of the following three measures: average earnings growth, so whatever wages are going up by, or inflation, or 2.5%. So the worst that you could possibly do is a 2.5% increase every single year. But actually, if inflation is much higher than 2.5 and average earnings are higher than that, then you get the benefit of the highest possible number. So this is a win-win-win if you're a pensioner, because everything keeps going up. But obviously, from the government's point of view, they've got to fund that. And if you're increasing the pensions, the state pension, by at least inflation or wage growth or 2.5%, then that's an increasing cost that you've got to cover from somewhere. You need to bring in more money from somewhere, and that somewhere is going to be taxes. So we've got that issue. We've got increases in the cost of the National Health Service in the UK, which is the free provision of medical care, which is still one of the only countries that provides that. So that's a great benefit if you live in the UK, but again, somebody's got to fund it. And then there's a lot of initiatives around getting to zero carbon emissions and other climate initiatives that they're looking to bring in. So investors are now becoming increasingly nervous about how the UK government is going to keep funding all of this increase in spending. And that's one of the reasons why gilt yields are currently going up, because people are selling their bonds. They're worried and saying, well, I'm not receiving enough interest to cover me for the risk that the UK government could default on this debt. Therefore, I'm selling. And as more people sell, simple economics tells us if you have a lot of sellers and not many buyers, then the price goes down. And when the price of a bond or gilts go down, that means that the yield goes up, because when we're talking about bonds, it's a fixed coupon. If the UK government issues £1 million worth of bonds and they have a 5% coupon on them, you get paid that 5% coupon for the whole life of that bond. So if it's a 30-year gilt, you'll get it for 30 years, you get 5%. But if interest rates suddenly double, then that means that you would want to be paid more than 5%. You'd want to be paid 10%. So if interest rates go up by double, then in theory, bond prices should halve. What we're seeing is bonds are being sold off, which is pushing up the price, the yield on the bonds. And when the government's having to issue new bonds to replace ones that are maturing, it's basically costing it more money. And that's what's going on right now. And that's why there's a big problem for the UK government. Now, if we have a look at what the government is spending its money on, this chart shows the breakdown for the full year of 2024 to 2025. So this goes up to the 5th of April, 2025. And you can see that it's been split out into the different segments. So the one that I'm looking to really focus in on is debt interest, which is the second segment from the top. And you can see that in the full year to April 25, the UK government spent £104.9 billion on debt interest. So that's basically the coupon on all of the bonds, all of these gilts that has been issued. So that's a lot of money. And when you compare that 105 billion to some of the other expenditure, it really puts into perspective the problem that interest is causing for the UK and the worse it's going to get if yields keep rising. So that 104.9 is actually significantly more, 50% more than the cost of the other welfare payments. It's significantly more than universal credit, which is one of the benefits if you don't have a job and you've got financial problems in the UK, then you'll be given financial credit through or money through universal credit. It's more than the UK government is investing. It was only 72 billion. It's three times more the amount that the UK government spent on defence. It only spent 37.5 billion on defence, but 105 billion on interest. And then education in 2024-25, the UK government spent £88.8 billion on education compared to 105 billion on debt. So that really puts into perspective the cost of this debt. And you can see here that the pension cost was 151 billion. And that's going to go up all the time because of that triple lock. And the issue that the UK government is facing is that the debt interest is also rising all the time because it's issuing more debt, because it's spending more than it's earning, therefore it's making up the difference by debt. So the debt's constantly rising, and the cost of that debt is going up rapidly. So this figure of 105 is likely to be significantly greater this year than it was last year. And that means that the difference between the amount the government is spending on interest and all of these other essential services like education, pensions, and defence is going to get bigger. So this is a real problem. Now, if I have a look at who's actually holding UK government debt at the moment, the chart on the left-hand side here shows the holdings dating back to 1987. So we're going back a very long period here, almost 40 years. And you can see that back in the 80s, the biggest holders of UK government gilts were the pension funds and insurance companies. They were holding around 60% of all of the bonds that had been issued. And that was because they were seen as a very good bet. You were getting decent interest of it. It was very safe. And so pensions put the money in there and they just forgot about it, just left it to run, and they'd take the coupon. Very happy about that situation back then. Other monetary and financial institutions were holding around about 15%. And then we had other financial institutions. And you can see the orange section at the top here is overseas holdings. And back in the 80s, that was sitting at around 15%. If we look at the situation today, you can see that the colour chart has changed materially. In fact, the pension funds and insurance companies are now only holding around 25%. So that's a big change to where we were in the 80s. And one of the reasons for that is because a lot of the pension funds and insurance companies were not very happy with the returns that they were getting. The returns started to go down significantly, and so they needed to invest into other assets to get better yields. There was a big scandal in the 90s where a lot of people who'd taken out insurance policies to pay off their mortgages, what were called endowment mortgages, didn't get enough back on those insurance policies, and so they had a shortfall and they had to sell their house to actually pay off the mortgage. So that wasn't very much fun for the people who had to do it, and so the insurance companies had to change the way that they were structuring things, and equally the pension funds didn't see enough of a yield from the government debt, and so they decided to move out of it. Now, if we look at where the changes have gone, you can see that other monetary and financial institutions are holding less than they were back in the 80s. They're holding roughly about 10% today. Now, one of the big changes is overseas holdings. So you can see that overseas holders have now got around 30% of all of the UK bonds. And then that yellowy orange section at the top is the Bank of England. So they're now sitting on around 30% of all of the UK government bonds. And basically the Bank of England is the last resort. They're stepping in with what's known as quantitative easing and quantitative tightening. They can step in and buy bonds and then sell bonds. So they're basically filling the gap that's being left by the market. So you can see that over the last 15 years, the gap has suddenly appeared, and the Bank of England has had to step in to support the bonds that the UK government is issuing because there's not enough demand from actual institutions. Now, the Bank of England obviously isn't going to be selling and putting the country into difficulty, but the overseas bondholders, there's a big question mark as to what they are going to do. Now, at the moment, we've got rising yields, which basically means bond prices are going down. And we've also got the pound falling. On the 2nd of September, it fell at its fastest rate since January. It fell by more than 1% against the US dollar. Now, that's a double whammy from the overseas holders' point of view, because when the currency starts to fall, the value of your overseas bonds actually goes down, because if it's weakening, then you're not going to get back more, you're going to get back less. So if you think about it, if you're a holder that has to report your accounts in dollars and the pound is becoming worth less in dollar terms. When you sell your bond, you'll get back less than you did originally. So the UK pound weakening is bad news for overseas holders because it means that the bonds that they're holding are worth less. And in addition to that, although bond yields are going up for new issuance of bonds, they don't go up for existing holders. You have a fixed coupon. But what it means is that the price of your bond is going down whilst the yields go up. So the price of your bond is also falling. So we've got a double whammy here, that the price of the bonds is going down and the value of the pound is also going down. So from an overseas holder's point of view, we've got a double devaluation. So that's likely to lead to overseas holders selling their bonds. And if we get further sale of bonds, then that means that the price of bonds will go down and therefore the yields will go up and the cost of the bonds to the UK government will also rise. So what's the summary and conclusion today? Well, I wanted to post this video because what's happening right now in the UK bond market is quite frightening from the UK government's point of view. Since the new government took over in the middle of 2024, we have seen spending increasing rapidly and tax receipts have not been rising at anywhere near the amount that they need to cover that increase in spending. So we're seeing the deficit, the difference between the spend and the income rising, and the only way to fund that deficit is by issuing more debt, more bonds. And the problem that the UK has right now is that the yield on those bonds is at a 27-year high. It's up to 5.7%. So every new bond that gets issued is going to be issued at a much higher rate than the previous bonds. If you think about the last 30 years, we saw the chart earlier, it's been a great time to be issuing bonds because the price went down all the time, the yields were very low, and that's great. But the problem is as they mature, as we see the 10-year bonds maturing, the 20-year bonds maturing, you're replacing them with higher rate bonds. So that's going to cost more on a like-for-like basis. But in addition to that, the UK government is also issuing more bonds, more debt. So therefore, it's got a double whammy. The cost of the existing debt is rising while they're replacing it, and the new debt that's being put into place is also more expensive. So this is really bad news. And as we saw from the breakdown, the UK government is now spending more on interest than it is on things like education and defence, which are obviously fundamental to the long-term future and security of the UK. So that's not really what the government wants to be doing. It doesn't want to keep increasing the amount it's spending on debt and reducing on public services. It wants to get the balance the other way round. Now, in terms of how the UK government is going to get out of this position, it's going to be very difficult because it doesn't have enough income to cover its spending, so it's borrowing more money. The only way to increase the income will be by to increase taxes. Now, there is a budget that's due to be announced in a few months' time, and it's likely that we will see huge increase in taxes to cover this deficit because borrowing from the markets is really unattractive right now when yields are at a 27-year high. Now, that's going to cause a fall in popularity of the government because nobody likes to pay more taxes. And this government said that it wasn't going to keep raising taxes, but unfortunately, it won't really have much choice. So it's likely that we'll see the increase in taxes, a fall in popularity, and it will be interesting to see what happens over the next 6 to 12 months, whether or not the general public in the UK is happy with what's happening with this government, because so far it's been relatively bad news along the way. But this could be even more bad news before we get to the end of 2025. So hopefully you've enjoyed this video. If you did, if you want to see me posting more videos on the UK, please give me that thumbs up. Pass a comment down below and also subscribe if you haven't done so already. Thank you so much for watching this video all the way through to the end, and thank you to everyone that supported me. If you bought me a coffee, sent me a YouTube super thanks, or signed up as a patron, a YouTube member, or a Buy Me a Coffee member, thank you so much for that support, and here's something to put a smile on your face.